Something changed in January 2025, not slowly, suddenly. Global stock markets plunged after President Trump announced sweeping new tariffs on imports from China, Europe, and other major trading partners. Within hours, trading partners began announcing their own retaliatory measures. Wall Street veterans called it the sharpest one-day decline since the height of trade tensions during Trump's first term. But this was different. The world had changed since then. The tariffs themselves were broad. They hit manufactured goods, agricultural products, technology components. China, the European Union, and others found themselves targeted. The scale suggested this was planned, not reactive. Market analysts immediately noticed the similarity to tactics Trump used years earlier, when tariffs became his preferred tool for negotiating over technology access and intellectual property. This was a return to familiar strategy, but the global economy was no longer the same. Since Trump left office in 2021, supply chains had been reorganized. Countries had quietly built new trade networks that relied less on American markets. The dominance of the dollar in global trade was being questioned in ways it never had been before. Trump's renewed tariff push arrived just as many nations were already reconsidering how dependent they wanted to be on the United States. The timing mattered. China responded within days. American farmers saw new tariffs slapped on their exports. Key manufactured goods faced reciprocal duties. The response was calculated, targeting products from politically important states. European leaders issued careful public statements about concerns over trade stability. But behind closed doors, according to leaked reports, the discussions were more pointed. European officials were talking seriously about reducing their reliance on American supply chains. The message was clear. Other governments were reading this not as temporary trade friction, but as a signal of where American policy under Trump was headed for the long term. Trump's economic argument centers on bringing manufacturing back to America and shielding domestic industries from foreign competition. Supporters say decades of free trade hollowed out American factories and that it's time to correct course. Critics warn about rising prices from tariffs and the risk of triggering trade wars that could break apart global markets. Both sides agree on one thing. Trump's approach breaks with the consensus that held since the Cold War ended. For 30 years, American policy pushed for open markets and integrated supply chains. That era appears to be ending. The implications go deeper than trade numbers. This reflects how Trump sees America's role in the world economy. For decades, Washington bet that economic interdependence would create stability and give America influence. Trump's approach suggests a different bet. He's prioritizing control over supply chains, especially in strategic areas like computer chips, rare earth minerals, and advanced manufacturing. The focus has shifted. It's not about maximizing efficiency anymore. It's about reducing vulnerability. China has been preparing for this. After Trump restricted technology exports during his first term, Beijing poured money into domestic semiconductor production. The Belt and Road Initiative expanded to lock in access to critical minerals and energy. Trade deals were signed across Asia, Africa, and Latin America. Many were deliberately structured to reduce dependence on the dollar. Trump's new tariffs might actually speed up these trends rather than reverse them. What started as economic competition now looks more like strategic separation. Europe finds itself caught between two powers. Trade ties with America remain significant, but European leaders have been questioning that dependence for years. Energy security became urgent after natural gas disruptions. Defense spending debates raised questions about whether American security guarantees could be trusted. Now Trump's economic policies add another worry. European leaders are discussing industrial policies focused on self-sufficiency in critical technologies. Strategic autonomy, once mainly a military concept, now extends to economic planning. Europe is hedging its bets. The impact on global supply chains is substantial. For decades, companies optimized for cost efficiency. They built factories where labor was cheapest and regulations most favorable. Inventory systems were designed to minimize storage costs. The whole model assumed stable trade relationships and open borders. Trump's tariffs throw friction into these networks. Companies now have to calculate geopolitical risk alongside profit margins. Investment decisions that once prioritized efficiency must now consider resilience and backup options. The business world is being forced to rethink everything. Financial markets show the uncertainty. Volatility has jumped as investors try to anticipate what Trump will do next and figure out which sectors are most exposed. Money is moving toward markets less tied to U.S. China trade dynamics. Emerging markets in Southeast Asia and Latin America are seeing increased interest from investors looking to diversify. Currency markets are swinging as central banks adjust their reserves and consider what fragmented trade blocs might mean. Some countries have quietly increased their holdings of euros, yen, and even gold as hedges against dollar-based trade disruptions. The dollar isn't facing immediate threat as the world's main reserve currency, but alternatives are being discussed more seriously than at any point in recent memory. Corporations are scrambling to adapt. Multinational companies that spent years perfecting their supply chains for maximum efficiency now face pressure to reorganize for safety. Some are announcing plans to move production facilities. Others are spreading their supplier networks across multiple countries to reduce concentration risk. These changes require massive capital investment and years of time. A single semiconductor fabrication plant can cost $20 billion and take half a decade to build. Pharmaceutical companies looking to diversify active ingredient production must navigate different regulatory systems in each country. Automakers restructuring their parts suppliers face coordination challenges across dozens of facilities. Moving from a globally integrated production system to one split by trade barriers represents a fundamental shift in how international business works. Companies that thrived under the old system might struggle under the new one. The full cost won't be visible for years. The technology sector sits at the center of this tension. Control over semiconductor production, artificial intelligence development, and quantum computing isn't just about economic advantage. It's about strategic power. Trump's restrictions on advanced chip exports have already changed where certain technologies can be developed and used. The tariffs add another layer of complexity. Tech companies must now navigate conflicting regulations, export controls, and market restrictions imposed by Trump and other governments. The result might be separate technology ecosystems with incompatible standards in different parts of the world. The internet could fragment along geopolitical lines. Research institutions are feeling the pressure too. Universities and labs across borders have driven innovation for decades through collaboration. Now, technology transfer restrictions and intellectual property concerns are complicating those relationships. Some research partnerships have been paused or restructured. Visa policies for researchers from certain countries have tightened. The long-term cost of reduced scientific collaboration could slow technological progress across multiple fields. Breakthroughs might take longer. Innovation might suffer. Whether Trump's tariffs achieve what he says they will remains uncertain. Bringing manufacturing back to America faces real obstacles. Labor costs are higher. Infrastructure needs upgrading. The workforce lacks certain skills. Building semiconductor plants takes years and billions of dollars. Competing for rare earth minerals means going up against countries that spent decades developing extraction and processing capabilities. The gap between what Trump promises and what's economically possible could be significant. How other countries respond will determine whether Trump's strategy works. If major trading partners retaliate proportionally while keeping existing relationships where they can, the damage might be contained. If retaliatory measures escalate and alternative trade networks solidify, the global economy could fragment rapidly. Early signs suggest both are happening. Some countries are hedging, maintaining ties with multiple powers. Others are picking sides more clearly. This represents more than a trade dispute. It reflects competing visions for how the global economy should work and who should have influence. The international order built after World War II was designed to encourage cooperation and manage conflicts through negotiation. Trade was seen as a force for stability. Trump's approach suggests those assumptions are being tested. Economic policy is increasingly viewed through the lens of strategic competition rather than mutual benefit. The outcome depends on decisions made not just in Washington, but in Beijing, Brussels, and capitals worldwide. How countries position themselves in response to Trump's policies will shape trade patterns, investment flows, and technological development for years. The tariffs announced in January might be remembered as a turning point, or they might be one development in a longer realignment of the global economy. What seems certain is this: the assumptions that guided economic policy for decades are no longer taken for granted. The structure of international trade is being renegotiated, and nobody knows how it ends.